For 30 or 40 years, your income arrived automatically every 2 weeks. The taxes were taken out, your 401k was funded, and the system worked on autopilot. Then you retire, and suddenly you are your own payroll department. Hi, I'm Sally Boyle, founder of S.J. Boyle Wealth Planning here in Hanover. And for over 40 years, I've helped local families navigate the shift from earning a living to drawing an income. And here's the biggest surprise most people will face when they start building a retirement paycheck. The largest account you own is likely one you have never paid any taxes on at all, not a nickel. And every dollar in your 401k or 403b or rollover IRA grew tax deferred while the government is waiting its turn. Now, how much of that you actually get to keep depends entirely on the order in which you draw it down, not just how much you saved. So today I'm going to break down the 4 pieces of retirement income. It is a retirement income puzzle, and how getting the order right keeps more money in your pocket because you're paying less taxes to Uncle Sam. So let's get right into it. Where does the money come from? Well, for most of the retirees I work with, they come from 4 sources. First is your Social Security benefit. Now, that's the most predictable. It adjusts for inflation every year, comes in every single month, and you decide the tax withdrawal. Part of it is taxable depending upon the total sources of income that you have. Now, the second of the income puzzle, for those of us who are lucky enough to have one, is a pension or a pension annuity. And again, it is taxed the same way your paycheck used to be taxed, ordinary income rates. Now, the third piece of this puzzle is your tax-deferred money. And this is your traditional IRA, your 401k, or your 403b. And this is the account that I first talked about, where every dollar you take out is going to count as ordinary income for you. And then there's everything else. There's your brokerage account, there's your savings account, there's your Roth IRA. And each one of these have their own tax rule as well. As an example, your brokerage account could be generating ordinary income for you if it's ordinary dividends and interest. It could be generating more favorable rates if you have held stocks for over 1 year, which would be taxed at capital gains rates of 15 to 20%. And then, of course, your Roth IRA is the most favorable because you've paid taxes on the money going in, and all of those earnings have accrued tax deferred and are tax-free when you withdraw them. So that's the most beautiful account. So we have 4 income sources with 4 sets of different tax rules. So which one you reach for first is a decision that you're going to remake each and every year in your retirement for 25 or 30 years, because you've gone from being that employee earning a W-2 taxed at the same rate every single year into becoming your own payroll department. And how you mix these 4 different types of income together will affect your effective tax rate, which is the total tax bill that you pay divided by your total income. So if that feels a little complicated to you, I don't blame you. It's really something that I hear quite often from people that I work with or prospective people going into retirement. And it's usually the first question that I answer in retirement tax planning. But there's also a lot of outdated advice in retirement income planning and very little advice available to you in this order of distributions. So it's why I wanted to show you why the order of distributions matter. Now, I'm sure you've heard the advice to spend your taxable accounts down first. This is some of that outdated advice that I referenced before. And to leave your IRAs alone as long as you possibly can, because the tax deferral allows them to grow. And it seems to make sense in the early years of retirement, because if you're drawing down from your brokerage account after tax money or favorable capital gains rates, your tax bills are very, very low. And that feels good because there's nothing that we like better than paying very little in taxes. But the trouble shows up later, because as you spend your brokerage account down, that IRA keeps compounding right along with everything else. And over a 10-year period at a reasonable 7% rate, it could double in value. But eventually, the IRS says, hey, it's time to take the money out because they want their piece, what we call required minimum distributions. And the age depends on when you were born. If you were born between 51 and 1959, your RMD years is age 73. If you were born 1960 or later, your RMD year is 75. But again, a bigger balance means a bigger required minimum distribution, which can land you in a higher tax bracket, certainly higher than you planned for, and probably higher than a rate that you have been paying to date. So you've also probably, by those ages, 73 and 75, started your Social Security. So these RMDs fall right on top of that income as well. It may pull more of your Social Security into being taxable, and it may raise your Medicare premiums 2 years later. So let me put some numbers to this to show you the math. This is a fictional couple, but it really sounds like a lot of the people that I work with every single day. We have a husband and wife who retired age 65 with about $1.2 million in their pre-tax accounts. They're living on savings and a small pension until they claim Social Security. So their taxable income settles somewhere around $70,000. Now, this puts them into a 22% tax bracket, which for a married couple in 2026 runs about $211,400. So on paper, they've got $140,000 of what we call bracket cushion. It's room that they could fill up their 22% tax bracket. And this may be useful if you made a decision that a Roth conversion makes sense for you. But here's where the do-it-yourself plans start to fall apart. Tax bracket is measured after deductions come out, your standard deduction, other deductions. But your Medicare looks at your income before deductions. And for this couple, it is closer to $120,000. So surcharges in Medicare begin once the couple crosses the $218,000 bracket. And that line drifts up a little every single year. So their tax bracket told them that they had a $140,000 cushion, but their Medicare bracket tells them they have a little under $100,000 cushion. And I'll tell you, Medicare wins because your tax brackets are guardrails, but your Medicare brackets are cliffs. Once you go $1 over a Medicare bracket, it could cost you thousands of dollars of additional Medicare premium. And that's not just for one of you, that's for both of you. And that's the difference between focusing in on tax brackets or running a one bracket calculation and running a comprehensive plan. And if our hypothetical couple, what if they did skip the withdrawals for 10 years? They retired at age 65, but decided to wait until they had to take their money out at age 75. By 75 again, they're probably taking in 2 Social Security checks. And these withdrawals arrive on top of that income. They're paying also a higher amount because their balance grew in their IRAs, and so their required minimum distribution grew. Now, they could have taken a lower distribution out years before and probably done it more cheaply. So nobody sends you a tax bill, you don't really know this. It's something that you have to proactively plan for, because if you make this mistake, defer until your required minimum distributions are due, you're going to pay this higher tax rate for the rest of your life. That's what the gap years are for. Those ages between 65 and 70 give you years where you can take this money out at lower rates, but they're even more valuable to us today because at least until year 2028, for those folks who are 65 and older, they have an additional deduction of $6,000 per person. So these years are especially valuable to us from now through 2028. Now, there's one other consideration. Let's say you spent your career at Dartmouth College or Dartmouth Hitchcock Hospital. You have one more account to consider, and that's your 457 account, which has its own set of separate rules. You can begin to take the money out of this account earlier, but you have to make that decision no later than 1 year of retirement. And you are going to have to make a distribution decision. So how that distribution decision factors into all of these others, your 403 distribution, your Social Security decision, all of that should be considered together. But let's get back to Social Security for just a moment. There's an even more important reason to create those gap years. Because every year you wait past age 62, your benefit grows right up until age 70. From 67 to 70, it can be a 24% increase. From 62 to 70, it can be 30% plus. So claiming early locks in a smaller check. And when you're married, that distribution or that decision echoes twice. Remember that when one spouse dies, the surviving spouse keeps the larger benefit and loses the smaller one. So the longer the higher earner waits to claim their Social Security benefit, the larger the benefit is to the surviving spouse. So it's the greatest longevity insurance that we have. And that could be critical because remember, the surviving spouse loses that smaller benefit, but they also the next year have to file on an individual tax basis, which means they're in higher brackets with narrower divisions after. And for that reason, probably less after-tax income. So this is a tax increase arriving at probably the worst possible time of their life, but it's entirely predictable. So the delaying claiming strategy is a question about you planning together for the one surviving spouse, but it also creates those gap years where Roth conversions can be done. Now, this last piece that I'm going to talk about has nothing to do with taxes. It really has to do with positioning your portfolio. Because as we know, markets go down. This is one version. There's not a version of a retirement where this doesn't happen, where we're not going to have some year where our retirement accounts will correct as the market corrects. But the damage comes when you are forced to sell when they are down, because you need money this month, what we call the sequence of returns risk. And it does the most harm in the early years, more than any other years. So what I suggest is that you hold 2 to 3 years of living expenses in cash. I'll call it your bridge account. And the point of that money is to give you the opportunity to withdraw for your income needs and give your portfolio room to recover before you have to touch it. So how does this come together in practice? How do I practically work with clients? How do we help clients? Well, we start with helping them determine their retirement number, their income number, because the income that you need in retirement is probably going to be different than the income that you're taking pre-retirement. Some expenses go down, some expenses go up. So what does it cost to run your life for that first year? And then we look at what shows up on its own: Social Security, pensions, annuity payments. And we determine the gap because that's the figure that the portfolio needs to cover. Now, what our clients walk out with is a schedule. Which accounts should fund this year, which accounts should fund next year, alongside a projection of their tax bill. And every year in December, we sit down and we look at how much is left in the bracket and what is a proper decision in terms of additional distributions if indicated. I also work directly with my clients' CPAs. Preparing a return is backward-looking, what happened this year, but planning is forward-looking. And when the two are not talking to each other, the conversions that have gotten done maybe have not communicated or maybe should have been taken, we make that decision in March when it is in fact too late. And what all of this adds up to is a paycheck that arrives on schedule, funded from accounts that make your income most tax efficient. So let me recap. The order that you draw from your accounts changes what you pay across the whole of retirement, not simply in 1 year. It changes the whole tax characteristics of your retirement income. The years between your last paycheck and your first required distribution have the most room in them and the most strategic value to you. A bridge account is what shields you while you use them. So we're not withdrawing from our accounts in down market years. And all of this is intended to build toward one thing, a paycheck that you can count on that is tax efficient. So here's your homework. And it's harder than it sounds. Count the years between the day you plan to retire and the year your required minimum distributions will be due, age 73, 75, whichever one it might be. Then ask whether you know what tax rate you will be in each of those years. Most people can do the first one pretty easily, but the second one is a little bit more difficult because it does require some modeling. Most people will avoid or not know what to do in those years that they are counting down from retirement to RMD years, but those years don't care whether you get it right or not. There's no way to buy them back to develop that strategy. So if all of this was useful, give us a like and subscribe to our channel. And if you'd like to know what your own years look like, I invite you to sit down with me for 15 minutes at no cost. The link is below and the office number is in our description. Whatever else you decide, count those years. That part you can do tonight. Thanks for watching.